What if I told you that securing your financial future after retirement doesn't need to be as complicated as you might think? Many of us push retirement planning to the back of our minds, assuming it's something to worry about later. But the truth is, the sooner you start planning, the easier it becomes to enjoy your golden years with peace of mind. Imagine being able to retire on your terms, without stressing over money. Sounds like a dream, right? Well, it's achievable with the right approach and strategy. In today's video, I'm going to walk you through the top 5 retirement planning basics that everyone should know to ensure a smooth and secure future. Whether you're just starting out in your career or already well into your journey, these tips are vital for anyone aiming for a stress-free retirement. Let's dive in. 1. Define your goals and timeline. The first step to successful retirement planning is having a clear vision of what you want your retirement to look like. Start by imagining your ideal lifestyle in retirement. Do you see yourself traveling the world, living by the beach, or simply spending more time with loved ones? Once you've painted that picture, set a target age for your retirement. This gives you a concrete timeline and a realistic goal for how much you need to save. Your retirement number, the total amount you'll need to retire comfortably, will be based on replacing about 70% to 80% of your pre-retirement income. This is often a recommended guideline, as it allows for a comfortable standard of living without the burden of daily work. The earlier you define your retirement goals, the more time you'll have to save and grow your investments. Creating a timeline and defining goals allows you to break down the big picture into smaller, more achievable steps. You'll be able to determine how much you need to save each month, what kind of investments you need to make, and how aggressively you should pursue those goals. More importantly, having a clear target in mind helps keep you motivated. The key is to start now. By planning ahead, you give your savings and investments time to grow, and you build a strong foundation for your future. Even if you can only save small amounts at first, those contributions add up over time. The earlier you start, the easier it will be to reach your retirement dreams without feeling overwhelmed. So, take the time today to define your goals and set realistic expectations for a secure and fulfilling retirement. 2. Understand different account types. One of the most important parts of retirement planning is understanding the different types of retirement accounts available to you. Knowing how each one works will help you maximize your savings while minimizing taxes. For example, workplace retirement plans like 401k often come with employer matches, essentially free money that you should take full advantage of. Contributing enough to get the employer match is a no-brainer. It's free money that helps your retirement savings grow faster. IRAs, individual retirement accounts, both traditional and Roth, also play an essential role in your strategy. Traditional IRAs offer tax-deferred growth, meaning you don't pay taxes on the money you contribute until you withdraw it in retirement. On the other hand, Roth IRAs provide tax-free growth, meaning you pay taxes on the money you contribute now, but when you withdraw it during retirement, the money is tax-free. Each type of account offers its own advantages, depending on your financial situation. Knowing the differences allows you to allocate your contributions effectively, saving on taxes now or later. By utilizing tax advantage accounts, you're ensuring that your money works harder for you and grows faster over time. It's crucial to understand the pros and cons of each and use them strategically to boost your retirement savings. 3. Prioritize asset allocation and risk. Your investment strategy will play a key role in building a sufficient retirement fund. The next step is deciding how to allocate your assets. This means determining how much of your money should be invested in stocks, bonds, and cash. Your allocation should align with your age, financial goals, and risk tolerance. Younger investors can afford to take more risks by investing a larger portion of their funds in stocks, which offer higher growth potential. However, as you approach retirement age, it's generally advisable to move towards more conservative investments, such as bond and cash, to protect your wealth and minimize the risk of significant losses. The goal is to find the right balance between risk and return. Over time, your asset allocation will shift naturally as you move closer to retirement, and your need for a stable income becomes more pressing. It's essential to review and adjust your portfolio regularly to ensure it aligns with your evolving needs and goals. A well-diversified portfolio, consisting of both high-risk and low-risk investments, will protect you from market volatility and provide consistent returns. By setting a strong foundation early in life, you can build wealth steadily while minimizing the impact of market downturns. Account for invisible costs. When planning for retirement, many people focus on saving, but an equally important factor is accounting for costs that might not be immediately obvious. These invisible costs can erode your wealth over time and significantly impact your retirement security. One of the most insidious of these costs is inflation. Inflation gradually reduces the purchasing power of your savings, meaning that the amount of money you save today may not stretch as far in the future. For example, what $100 can buy you now might only buy you $50 in 20 or 30 years, depending on inflation rates. To account for inflation, you need to adjust your retirement savings plan and income expectations to ensure that your money retains its purchasing power over time. Another major invisible cost that often catches retirees off guard is healthcare. While Medicare covers some health-related expenses, it doesn't cover everything, and out-of-pocket healthcare costs can add up quickly. In fact, healthcare often becomes one of the largest expenses in retirement. Research shows that healthcare can account for a significant portion of a retiree's budget, especially in the later years when medical needs tend to increase. To prepare for these expenses, it's crucial to either set aside extra funds in a health savings account, HSA, or factor healthcare costs into your overall retirement budget. By recognizing and planning for these invisible costs, you can take proactive steps to protect your retirement savings. Accounting for inflation in healthcare allows you to set more realistic financial goals, helping you avoid financial stress and stay on track for a secure, comfortable retirement. The earlier you prepare, the less likely these hidden costs will derail your retirement plans. 5. Develop a sustainable withdrawal strategy. Once you've saved enough for retirement, the next crucial step is having a strategy for withdrawing that money. Without a plan in place, you risk running out of money too early or losing too much to taxes and fees. A widely recommended strategy is the 4% withdrawal rule. According to this rule, you can withdraw 4% of your retirement savings each year, adjusted for inflation, without running out of money for at least 30 years. This strategy allows you to enjoy your retirement without constantly worrying about running out of funds. However, the 4% rule is just a starting point. Depending on your lifestyle, healthcare needs, and other factors, you may need to adjust your withdrawal rate. Some experts suggest withdrawing less than 4% if you plan on living a long time, or if your retirement savings are lower than you anticipated. To ensure your retirement fund lasts, it's important to monitor your withdrawals regularly and adjust them as needed. Additionally, make sure your portfolio continues to grow during retirement, so you're not solely relying on your withdrawals. By developing a sustainable withdrawal strategy, you ensure that your hard-earned savings will support you throughout your retirement years. There you have it, the top 5 retirement planning basics that everyone should know. Whether you're just beginning to think about retirement or are well on your way, understanding these principles will help you build a solid financial foundation. From setting clear goals and timelines to knowing how to allocate your assets effectively, each step is a building block toward a secure and enjoyable retirement. Remember, planning for retirement is a long-term strategy that requires consistent effort, smart choices, and adaptability. By taking action now and making informed decisions, you'll be able to set yourself up for financial freedom in the future. Start small, stay disciplined, and monitor your progress regularly to ensure you're on the right track. If you found these tips helpful, make sure to like, share, and subscribe for more valuable content on financial planning, retirement, and other important money tips. Thanks for watching, and I'll see you in the next video.